Hey guys, Small Cap Science here. Welcome to SCS Labs, our new platform where we're going to be talking through different alpha drops, current projects, brand new launches. We'd like to get some alpha out on pre-launch projects, really discuss some stuff for newbies as well, like how I research projects, different tools I use, as well as just some general education. So lots to come in the next few months. Please like, follow, subscribe, whatever it might be, just to make sure I'm not talking to myself for these if you want to see more. Today we're going to be doing a deep dive. I think this one's probably going to be a little bit more complex than the majority of the videos I do. I'm going to be diving into Camelot DEX. It's a brand new DEX that just launched on Arbitrum. It's a very new model, so I'm going to try and go through some of the different complexities of it, dive into their tokenomics, talk through why I'm extremely bullish on it, ways that it could upend different liquidity markets, and also just a future outlook of things to look out for, ways that I actually evaluate the project, and dive into some of the white paper as well. So let's get started. So to kick things off, I think it's important to really dive in and say, so what's wrong with the current DEX model? Not to pick on Trader Joe, I absolutely love Trader Joe, but when you look at almost any DEX chart out there over the past few years, everyone has a very similar chart. It's very chicken and the egg, where you need to be able to pull liquidity in to make sure that trades are happening on chain, to make sure that you're getting the swaps needed to earn fees. Like if you don't have deep liquidity, then you don't have swap fees and your DEX fails. But you also need to incentivize liquidity to use your platform. So a lot of these DEXs had very, very high emissions. Everybody would rush into the platform. They would all provide liquidity. And then as price tanked and emissions started to catch up, all of the charts really dumped off. This is a model that almost every DEX has used, but this is a model also that can definitely be improved upon. That leads into one of the reasons I'm so bullish on Camelot is they, instead of incentivizing that short-term liquidity, with Camelot, they really planned on starting very small with their APRs and growing with the TVL, which makes it extremely bullish. And a lot of the burn mechanisms they have, a lot of the ways that the protocol profits off of volumes really make sure that instead of the price nonstop falling, it should rise based off of the usage of the platform. So definitely a shift in how we look at DEXs currently. Also, one of the reasons that I think it's so important to cover this model, and I think a lot of you will enjoy it. Like I mentioned, it is on Arbitrum. As a whole, I've been spending a lot of time on Arbitrum. It's one of the more bullish areas as far as where builders are going. Optimism and Arbitrum layer 2s are actually getting more volume today than ETH mainnet. So what exactly that looks like is how do you prepare for the next bull run is you want to go where not only the builders are, but also where the network activity is happening. People who are coming in, retail, even the apes, they don't want to be spending nearly as much on transaction fees. A lot of the new projects aren't launching on mainnet. So Optimism and Arbitrum are kind of the places to be going forward. And I think that opens up a massive market with all of these new launches. When you look at specific L2s on ETH, you have Arbitrum 1, Optimism, DYDX is kind of its own, Metis, which I've talked about quite a lot on my Twitter. It's really, Arbitrum's the largest in that market. They're also yet to launch a token. I think it's been hinted at so many times that they'll eventually drop an RB token. But being able to have $2.7 billion of TVL is pretty wild. That's a massive, massive share of liquidity, especially in a down market. Bound to explode, in my opinion, when it heads into the next market. I'm not saying Optimism won't win the war, but one of the reasons I'm targeting Arbitrum so heavy as well as Optimism. When you look through some of the different volumes of DEXs on Arbitrum, it's been kind of weird. There hasn't been a standout winner, but when you're looking at volumes across Arbitrum, it's 162 million today. Taking a look at the top 10, I think this is so ripe for the market to be upset. You look at Camelot, currently has about $7 million over 7 days, where you're seeing some of these top DEXs, when you look at the top 5, anywhere from 50 to 500 million, that is a massive jump in volume that Camelot would have to make up to get into that conversation with some of the big boys. But also the way their model works, I think it's entirely possible, and they profit off of volume. So it's extremely important to, when you're looking at Camelot's average volumes, which are up 108%, to consider, hey, if it does get to these points, what exactly does that look like from a fee standpoint? And we'll dive into some of that. So what makes them special, or what do they do differently than your average DEX that has gone straight down because they over-emitted their token, is they focused on project-owned liquidity from a bunch of partners across the Arbitrum ecosystem. They've kind of said, like, hey, what do users normally provide to a DEX? They come, they provide liquidity until the market gets bearish, get scared to lose their money. They pull their liquidity, they sell their tokens, and the protocol's not only losing like their actual TVL, there's a lot of dumping that happens from the entire ecosystem standpoint. So Camelot said, we're going to build a DEX and we're going to prioritize the people who use the protocol the most and can provide us with the most liquidity. And what that is that's project-owned liquidity from a lot of their partners. So they went to all of these different protocols within Arbitrum, and they partnered with them. And if you look at how they distributed GRAIL, like right out of the gate, they have 10% going to their own POL, which is a massive amount. Ecosystem, that's 5%. Reserves is 8%. Partnerships is 10%. Development funds, 2.5%. Like those 3 or 4 to me all mean almost the same thing, is we're going to use it to build up everybody we work with across Arbitrum. And that's almost 25% of their entire tokens. So like, why would a brand new project or a current project on Arbitrum like work with Camelot? Because they're going to give them a piece of vested interest like within Camelot. So they'll give them some like xGRAIL tokens that vest over the next 6 months to 2 years. And then it's like getting a call option on the entire Arbitrum ecosystem, because the token like price actually does follow the volumes on the platform. So one of the things that they've done so well is their business development. One of the things that I'm super excited about, and I've discussed this before, is like they use a 2-token model. You want to find ways as a DEX to disincentivize short-term users. It makes it extremely inconsistent that you have like TVL leaving. You need to find long-term users and ways to incentivize them. So part of it's like, hey, why not use some of those swap fees and pay those back to users who are willing to stake for an extremely long time, or like have vesting tokens where there's some dilution and lower emissions, and like have them vest over time to encourage those long-term users that actually end up sticking with your platform in the long run. So that's exactly what they did. If you look at their GRAIL 3-year release schedule, it looks a little bit scary. If you look at it from face value, going from about 30% of token supply at launch to just over 60, that's over 2x in a year, but that's just taking it for face value, not counting, I guess, some of the vesting that needs to happen, as well as some of the burns that are worked into the ecosystem. So if you look at this, anything in blue is their GRAIL token, which would be their liquid token that's tradable. And then all of this green up here is their xGRAIL token. So although like there's a decent amount of emissions year one, all of these emissions are, for the most part, are happening in xGRAIL, which is illiquid. So a lot of that supply is going to people who are getting long-term stakes in the DEX and are going to stick around to earn fees based off of the different volumes that happen on the platform. So liquid GRAIL, on the other hand, is going from about 30% total supply to just under 40 in a year, which is pretty tiny based off of the standards of the normal DEX. So pretty cool. They did the model this way, and like honestly, super excited to see it play out. So they did a public sale when they launched. It launched at about $254. I think it's about $464 today. It launched at about a $25 million FDV. And I believe, market cap of about 5.7 million. It immediately crashed, which was interesting to me because everybody got the same price when they bought in. So everyone was buying at that 254 marker. But people weren't aware that I think like 80% of the buy-in was you got back in GRAIL, 20% was in liquid GRAIL. It tanked and went down to about 200 right out of the gate, and since has recovered in a very big way. Don't know why people were selling at a loss right out of the gate, but hey, we are in a bear market. So, I mean, overall, extremely successful sale, like $3.8 million for a brand new launch on Arbitrum in a bear market is awesome. So touching on the public sale, like they did it to bootstrap. They didn't have any VCs. They didn't have massive holders coming in. So they wanted to do it so everybody's buying in at the same price. They're going to be giving up some of their supply to partners, but those don't vest, I believe, for at least 6 months. From there, like half of that $3.7 million went to their owned liquidity. So pretty massive. Then they also have a war chest of 30% of it. So they raised, $3.7 million. That's over $1 million that they have set aside to bootstrap dividends over the first 6 to 12 months. So it makes it pretty compelling if they're ever low on fees and like need to pay out xGRAIL holders. Also help pay off the team. I will say, like, the team gets about 20% of this. At first, I thought that sounded like a lot of them getting 20% of token supply. But when looking at Curve, Balancer, and some of the other like large dexes, it's actually lower than most of those, which kind of shocked me. But I guess it makes sense when you need to control at least a decent portion of supply for governance and other issues. But like in the end, with them only having 20% and like having so many partners across Arbitrum, it ends up being a very, very strong governance structure. Like there's going to be all of the top projects that own a decent portion of locked supply, or at least non-vested supply. So like their governance is going to be like really out of this world. Pretty excited to see some of that play out. But yeah, just once again, touching on really quickly how they had it set up. 15% went to the public sale, 10% went to project-owned liquidity, and they had the Genesis Nitro Pools that are ongoing. It's worth probably touching on the Genesis farms. I think this is a pretty awesome concept. So back to like, hey, what's wrong with DEXs today? It's very hard to get sticky liquidity. So what they did is they said, hey, you have until this date to stake it on our site, and you'll be getting up to 5% of the supply. There's 5% of total supply given out over 6 months, which is a massive amount if you really think about it, considering they only have 22.5% set aside for liquidity mining. So there is a decently heavy amount going to Genesis pools of people who were early stakers and contributed their liquidity. But how it works is they pulled in like, I believe it was like 15 million or something like that right off the bat. I'll pull up a chart here in a little bit, but those people, they can unstake at any time, but then nobody new can come into those Genesis pools. So they were able to pull in all of that liquidity and say like, these people are probably going to stake for the next 6 months because nobody can dilute them for like, they just can't come in and stake on top of them and earn those Genesis rewards. It's only people who were in early. But also it makes sure that their TVL is super sticky for the first 6 months when it's most important as they grow out their different partnerships. So really love this concept, and I'm excited to see if they do anything more with it down the road. Would be interested to see if they like try and structure like another round of Genesis or something like that after these run out. It would have to be at a much lower emission rate, but we'll see exactly what they do there. When you look at really how farming emissions work, like I mentioned, all of these tokens really blew their bag early on emissions, and from there, like as their APRs fell due to the price being dumped, salt on the wound that their APRs were falling because they did the highest emissions up front, which really doesn't make that much sense if you think about it conceptually. So they did it, hey, we're going to have higher emissions as we grow. And due to them having a model where like the more volumes that happen, the higher the burns are, it makes a lot of sense that as they get more partners, the emissions can be higher. So like this is really kind of the curve that their farming emissions go on. It gets heavier and heavier heading into the 6 month mark. So honestly, even though it's been launched for probably about a month now, you're really not late because emissions are just really kicking off. I think one of the more important things to note is if you look at GRAIL versus xGRAIL emissions, 80% of emissions are in xGRAIL. So the amount of liquid GRAIL that's actually being emitted by these farms is near zero. Pretty cool. And I'll dive into why I think that's extremely important. But the way that they did it is, hey, like we're going to have increasing rewards. We're going to do our best to make sticky TVL through the Genesis pools. We're going to pay out a ton of xGRAIL like over the course of the first year because we want to make sure that we are the native DEX of Arbitrum. And we're going to partner with some of the best protocols by giving up a percentage of supply. When you look through their partner list, it's pretty insane. Not all of these have moved over all of their liquidity, but all of them have partnered from some way, shape, or form. As the TVL continues to rise, like you'll see these projects move over their liquidity entirely to Camelot. But GMX is a partner, Liquidity Protocol, which is massive, LUSD and ETH pool. I think somebody just minted like 50 million worth of LUSD this week. Factor's building out a pretty cool protocol that is going to be doing some asset management, and they're going to be accumulating a bunch of Arbitrum tokens. Just Bet, this one's done like a 30x in the past like 2 weeks. It started with a super small market cap, but Buffer Finance is moved over and it's done extremely well. Has pretty awesome APRs to start out. You have Jones DAO that's going to be launching some of their new products, JGLP and JUSD. Those will be launched exclusively on Camelot. So all of these protocols, like top tier protocols too, and some that are launching exclusive pools that aren't going to be able to be found on Uniswap, Sushi, and some of those other big dexes are now launching on Camelot. And that's an extremely big deal. and part of it's due to the incentives that they offer. Piece of that is like they're also going to be doing net new protocols. So Vela, I don't know if you guys are familiar with Vela. It's a GMX-like protocol. It has synthetics already built. I think that there's going to be a lot of apes that ape into this one from a liquidity standpoint. And they're finally opening their Vela token on Camelot. But these launches are going to drive so much volume to the platform. So like I'm extremely excited about these because once again, like I'll dive into tokenomics a little more, but everybody on Camelot is going to profit off of higher volume. So these big launches and being exclusively on Camelot is a very big deal. They also had Nitro Finance that just launched on their launchpad. Their launchpad, I don't think it has any fee accrual back to the actual holders, but like this is an awesome idea for them to like do like permissionless launches for different protocols. They launched their own token through this launchpad, GRAIL. Pretty cool system. I think they're going to let anyone really just launch off of these. I don't think they're vetting these projects, so I'd take it with a grain of salt and not just blindly ape and assume that they did the DD for you. It has a referral system built in. It allows you to raise based off certain market caps, builds the FDV for you. But from a Camelot perspective, this gives new projects a reason to completely launch on Camelot. So I really like this for helping build out their business model. And I also think it helps some of these projects get exposure. Even if Camelot doesn't necessarily vouch for them and say like, hey, we've done our research on this, like I do think like just them launching at Camelot is going to give them exposure long term. So they just launched. I think they were doing extremely well from like a volume standpoint. Did want to touch on like when you look at basic volumes, GMX itself is doing about 310K of daily volume. Vela did just launch, so I probably can look at this. Wasn't really planning on it. There you go. Yeah, I mean, it's almost $1 million in volume just off of itself. If we take a quick look back, that Camelot's only doing about 7 million a week. So, I mean, just that one token launch with Vela, and that's not even like their VLP token, is already doing a day's worth of volume here in a few hours. So, like, those launches are going to be massive, massive for like fee generation. Super excited about it. That's where the majority of the profit's going to come from. When diving into it, why exactly some of this matters, like from a fee perspective, when you look at how Camelot inherently works, the way that they do fee structuring is you stake your xGRAIL and you earn dividends. So it's like real yield, which everyone normally gets extremely excited about. Take 22.5%, they pay it out as dividends to only people who are staked in xGRAIL. They have a 12.5% buyback and burn. So like if you look at like the past 24 hours where there's 4.2K worth of fees and $1 million worth of volume, this is probably a little bit outdated because of the Vela launch. If you have 4.2K of fees and 12.5% of that is going to buyback and burn, that's $450 of buy pressure a day. Multiply it. I would assume this does multiple X's if you consider like the current volume on Vela plus VLP plus GMX plus all of the new other launches that they do. Those volumes are only going to continue to increase. And honestly, there's a very good chance it becomes deflationary because the thing that you need to consider is even if you're only burning like two GRAIL based off of these fees, it's liquid GRAIL. You're buying it back on the open market and selling it. Most of the emissions are actually in xGRAIL. So it becomes deflationary quite quickly because there isn't a whole lot of liquid GRAIL that's there to go around. So I'll dive a little bit deeper into that in a second. But going back to this, like the dividends distributed to xGRAIL holders, and I think this is extremely important. And the reason being is they're giving such a large portion of swap fees back to their xGRAIL holders. Most of xGRAIL is being held by partner protocols. You can actually earn dividends at like 20% of your entire position. You got that position for free. They're paying out dividends on the position that they gave you for free, paid out in ETH USDC. And then on top of that, you no longer have to pay for your own emissions. So like the way that they built this protocol, it's entirely with other protocols in mind. So say you're on Optimism. Currently, if you're a protocol today and you need liquidity, you probably go to Velodrome and you bribe them to point rewards at your LP. So you're paying out your own token, which is still emissions, even if you get it at a discount. You will pay them to have a deep liquidity pool. You don't ever really know how efficient that's going to be. It's very hard to do over a long period of time. And it just gets to be extremely expensive. Like when you look at some of the big protocols like Frax and Rocket Pool and Lido, all of those, like the amount that they're spending on bribes is absolutely insane. So Camelot kind of takes that away. Like they're giving you a portion of the DEX to partner and bring over your own project-owned liquidity. And then on top of it, you profit on all the volumes that happen on that entire platform. So if you're a small project, like let's say you're Factor and you're just launching, over time, you're going to start to earn a pretty decent amount based off of the larger projects volumes that are happening on Camelot. And you're going to be able to create a flywheel with this. Like say all of a sudden, right now there's only $1.7 million in volume happening right now. That's going to expand so heavily, especially during a bull market, that eventually you could be earning $100K, $1 million every few days. And like, what can you do? You can go and if you're Factor, you can go buy back your own token. You can turn it into project-owned liquidity. Like they're pretty much not only giving you a call option on volume on all of Arbitrum, but they're paying you to take it by just moving over your profit or your project-owned liquidity. Like if you're Vela and you got a 1% say of GRAIL, that's already worth $400,000, something like that on a fully diluted amount. You're earning 22% on 400K. That's a pretty wild amount of rewards, like over the course of a year. It's what, 80K? And that's on the low end. Like this is like, hey, this is infant days. So they're earning 80K a year in ETH USDC. If you're Vela, you can sell the ETH part of that, make it all USDC, and then turn it into VLP, like your own liquidity token that your customers are going to trade really perps through. So like it's a pretty wild deal from that perspective. And like what they get in return is the fees based off of like the swaps that your community does. It's a very good trade-off and so much more efficient than really, I think, a lot of the ways DEXs operate today. And I think that shows. Like if you actually look at their TVL chart, look how stable their TVL is. You don't have people leaving. You don't have like big spikes. Like this is just steady growth. Honestly, extremely impressive. I only see this really going up and following token price for the time being. Like token price did a 2x. Like I see this like starting to send with it. So I mean, when you start to look at volumes, like look how steady this is. As they do more business development, which they've done an amazing job of, honestly, like this is only going to rise. I think you can start to see like where some of the volume's coming from. I think one of the most genius things about it is they pay rewards out in ETH USDC. If you know Solidly Forks well, almost all trades are routed through that main pair. So in this case, it's ETH USDC. If you're trading ETH for Camelot, that trade is done through ETH USDC to USDC Camelot. This ends up being the pair with the most volume, but also like them paying rewards out in it most likely means that like a lot of those partner protocols are going to be stacking it in their treasury, or they'll have holders stacking it or just not claiming rewards because it's not gas efficient for them or tax efficient for them at any given time. So like over time, it's going to make their main pool, ETH USDC, extremely deep, and their trades are going to be very efficient. So I can see a world where if they keep growing their volumes and these fees get larger, because once again, like that 22% of all volumes end up coming back to these dividends, could end up being a pretty massive amount. And that all of a sudden they could have the deepest ETH USDC pool on Arbitrum. Something to consider. And hopefully some of their partners end up leveraging that to like stack their treasuries. I don't see why they wouldn't, but I can also see a lot of projects building flywheels off of it. If you're, say, SpareX, like SpareX doesn't have a ton of liquidity. I think they have USDS, and anytime you mint USDS with USDC, it burns a little bit of SPA. So they can take their ETH USDC. There's only like 2 million USDS in circulation. They can make a USDS USDC pool. It burns SPA every time they mint if they do it weekly. And then they can take their USDS USDC, stake it in one of the yield farms here, and earn even more GRAIL. So like by using project-owned liquidity here and like growing their own liquidity on based off of volumes of the entire Arbitrum ecosystem, they're also going to earn more GRAIL and their treasury is going to grow. It's going to pull the entire Arbitrum ecosystem up with it, is the way I look at it. And the more and more volumes that get pushed through Camelot and the more projects that start leveraging this, I think the ones that are early and have big partnerships with them or good partnerships with them are going to have massive flywheels based off of the rewards that they get here. And also, like, like you're getting really diamond hands. Like a lot of these projects aren't going to sell, especially if they're printing rewards for their treasury like that. Hell, you can pay your team just based off of a lot of those rewards. So pretty insane stuff. I think it is pretty cool looking through, like based off of some of the fees, like what some of the biggest pairs are from a volume perspective. Like I said, GRAIL's gone nuts the past few days, earning a decent amount off of ETH. This Vela pair has gone absolutely nuts because, I mean, it just launched a few hours ago. 600K liquidity, earned 300 or 3,000 in fees. Pretty sweet. These are going to start to really pick up. I mean, if you look at fees over liquidity, like all of these are massive. They're just growing so quickly. It's pretty exciting stuff. I think if you really want to get bullish and talk about a long-term perspective, when we go back and look at, all right, what are some of the main DEXs doing from a volume perspective? Like ETH here is doing 560 million, Sushi's doing 188 million. Even some of these smaller ones, like Trader Joe on Arbitrum is doing 11 million. That's still 50% up from what Camelot's doing. That's a pretty big jump. Even from there, like the amount of fees going up 50% is like constitutes a lot more burns. There's been about 28 million that's happened on Camelot so far, 7 million in the past week or average. One of the things that got me pretty excited when you start to talk about, hey, what's maybe the long-term play here and what's it look like? Well, considering that Arbitrum and Optimism are having more transactions today than ETH, it doesn't mean they're higher dollar value. But like I went and looked back based off of some of the last bull run and said like, hey, what are some of the top DEXs doing from a volume perspective? So like, I mean, if you scroll over a few of these different dates, like I think maybe a good comparison would be Spooky Swap here. It was doing about 150 to 300 million. Like FTM, like there's a lot of competition from a DEX standpoint. There's Spooky Swap and Spirit Swap. It was a smaller chain, like didn't have as big of TVL as some of the big boys, but it was still doing about 310 million a week. That's actually 310 million a day. I wasn't even on weekly. So if you go to weekly, they were doing 1.6 billion a week on Spooky Swap. Spooky Swap was never that massive when you consider FTM as opposed to ETH mainnet, and it was doing 1.8 billion a week. That's what, 1,000x away from like what Camelot's currently doing. If they start pulling in a bunch of these like blue chips, I would say, or some of these protocols that pull over liquidity or exclusive partners start to really take off, this thing's gonna like go nuts because all of those dividends are gonna be paid out to users based off of those volumes. So can you imagine the fees on $1.8 million in volume? If I look back at like this page, 1,000x higher from a fee perspective, I mean, that's 4.2 million every 24 hours on fees. And there's a reason those fees are so high. I'll dive into it here in a second. But when you compare it to something like Spooky Swap or even Trader Joe here doing 5 billion, the amount of fees that are going to be earned on something like that is huge. And I think there's a bigger market compared to FTM and Avalanche for Arbitrum. We're at like all-time low volumes. That doesn't mean we won't go lower. But I mean, like Spooky Swap's doing what, 55 million today? Even that is 25x from where we are today from a fee standpoint. It's $105,000 in fees per day. 38 million in fees a year. If you want to talk maybe like 15, like PE ratio, that's like 575 million is what that would be worth from like a fair value, which is fully diluted value. That'd be 5,700 per token. I'm not saying it's going to get there. That's a pretty conservative estimate if it's based off of Spooky Swap here. So I think when you look at this, it's like, how do you not take a chance on a long-term position on what could be the biggest DEX, native DEX on Arbitrum? A few points that I'd like to make. I think everybody looks at this chart. I'll never tell you to ape massively into a chart that looks like this. With that said, I am holding this long-term. Probably hold it until the 6 month mark. I think there's a lot of stuff that happens at 6 months that should make this quite interesting. Like Genesis pools end, so that's 5% of dilution that stops. A lot of that TVL is going to unlock. So it's like, hey, what's going to happen with some of that TVL? Rewards start to increase towards that point. And like there will be unlocks. Like a lot of people who are farming right now are vesting their GRAIL to xGRAIL. How you turn xGRAIL into GRAIL is extremely important. So right now, if you wanted to vest at a 1-to-1 ratio and you want, hey, I want to get 100% of the farmed amount from my xGRAIL, you have to vest it over a 6 month period. In order to get it sooner, you can do as low as 15-day vesting, but you sacrifice up to 50% of your stack. So say you have 100 GRAIL, you want to invest in 15 days, 50% of that gets burned immediately. So that ends up being a massive amount of supply that gets burned. But also, like, what it means is, like, anybody who's farming today and maybe got in early, like, there might be some pretty big unlocks coming at the 6-month mark. But, like, I think a lot of that's to be determined. There's ways that you can look into it. It's something to keep an eye on. And the burn rates have been massive. Like, if you look at this, like 447 GRAIL have already been burned. 500 would be 0.5% of total supply. Like, that's pretty nuts. I wish they maybe did a little bit better of a job in the UI showing this, but not all of this burn supply came from liquid GRAIL. If somebody is redeeming for 50% of their stack from xGRAIL, that's xGRAIL being burnt. And that's different from the 12.5% that comes from fees, where you would buy it back and burn it from liquid GRAIL. The ones that, like, the buyback and burn affects price 10x more. All the redemptions do, like, if there's a ton of people redeeming extremely quickly and taking big hits on that, it just lowers the FDV of the project for the time being, because that GRAIL was already e-liquid being xGRAIL anyway. Another thing that I think is probably pretty important to cover is, like, right now about 47% of the GRAIL supplies in xGRAIL. That's really low. And the reason I say that is because, one, this is buying back and burning. Like, all of these fees are buying back and burning GRAIL daily. So liquid GRAIL's not that easy to get as it stands already. And then you have the buyback and burns. And then all the rewards that are paid out from the farms. Remember I said 80% of them are paid out in xGRAIL, 20% in GRAIL. So the majority of emissions are in xGRAIL. So the 20% that you're earning in GRAIL, it shows that this ratio is a little low. Like, I think this is probably going to trend to maybe like 70, 75% or something like that of the share of GRAIL supply being in xGRAIL, just because emissions over time, it's naturally going to trend up. One of the things that I originally disagreed with was, hey, like, I think you guys should have a much heavier incentivized GRAIL USDC LP. And they disagreed with me. I was 100% wrong. I'll be the first to admit it. And the reason being is because they have massive project-owned liquidity. It's like it's probably 5 million at this point based off of some of the price action. But this doesn't do much for them because they have such large liquidity on their own. Like, they don't need people providing liquidity outside of it. So if you're a user, you get 29.5% APR, like, providing liquidity, or I believe it was 20% providing, like, xGRAIL for dividends. 65%, this is if you lock the position and for like a 6-month period. But why would you lock it for 6 months if you're going to suffer IL? And then on top of that, like if you're going to lock it for 6 months, just go to xGRAIL anyway, is probably what I would do. But the reason this is important is because any person who's new buying into the protocol, say it's Joe Schmo, they just found out about it, and they're like, all right, I'm buying into GRAIL. The majority of them are going to buy their GRAIL, convert it to xGRAIL, and stake for dividends. So that also is going to be another reason that really GRAIL is going to be deflationary, because people buying in who weren't in from the start or aren't farming it and want to have a position in xGRAIL, the only way to do it other than farming is to buy in and convert GRAIL to xGRAIL. So I really see this trending way closer to like 70, 80. I could be wrong about that, but that's just speculation on my part, that, like, because people buying in are going to be forced to convert it to xGRAIL and there isn't a ton of emissions, that coupled with the buyback and burns, like liquid GRAIL, I think it's going to be pretty in demand is what I would say. Another important piece, people will say, like, hey, like, how do you know that project-owned liquidity is going to be efficient? And if you look here, they have 5.6 million now. Damn, that grew so fast in POL. But what that actually looks like, so there's only 448K of user funds in here and 5 million of the project-owned liquidity. So that's growing at all times. And part of that is because of their directional fees. So this allows projects to set fees based off of buying and selling that happens on the platform. So GRAIL has like a 1% fee on sell volumes. So what they do is when people are actually selling, if you look at some of the prices here, any person who sells their tokens, it's actually at a 1% discount compared to all of these buys. So if you look at maybe like this sell and this buy, just over a $4 difference, which would be 1% on $459. So they charge you that 1%, but what that does is their massive amount of protocol-owned liquidity, like in this case, it's $5 million, earns on all of that sell pressure. We were doing some quick math based off of fees, and it was almost at 70K that it's earned since the launch of the project. So they had 4 million in POL, maybe even just under. I think it might have started at like 1.5 actually, thinking back. That has now grown to 5 million. And then on top of that, they're earning based off of all those volumes. Those volumes all stick with them because they don't have a big yield farm that all their users use. So like they're earning 40, 50% on 5 million. It's pretty impressive. So this is a piece that a lot of people haven't caught on to yet. And it's also one of the reasons the chart looks like it does. So if you look at this, like there's decent amounts of sell pressure, but it starts to eat them up because of the 1% fee, and it just builds liquidity. Camelot as a whole actually profits off the volumes, and realistically, it's not going to go down unless there's a ton of sell pressure. Like to have this sell off like 30% is going to take a massive amount of liquid GRAIL being sold, and like once again, there's not that much liquid GRAIL. So if you take a look at GRAIL here, so there's 6,000 GRAIL pulled into this LP. For the most part, this is all project owned. If you look at circulating supply, it's about 24,500, so about 25% to FTV, and circulating supply is about 11,600. So 13,000 liquid GRAIL supply as of right now, and 6,000 of it's in LP. And there's a 1% fee on the directional dynamic fees that they built in. It's going to be pretty hard for this to sell off as heavy as people think it's going to. So I think there's, once again, going to be a lot of people and users caught on the sidelines because the people who own the GRAIL and are farming the GRAIL are projects. So if I'm Vela and I have 5 million of the 20 million TVL, I'm just making up these numbers, but as an example, if I have 5 million to 20 million total TVL of like Camelot, and I'm earning a ton of the liquid GRAIL emissions, I'm not probably selling those because I'm counting on this platform doing well long term, and I already have a stake in it. So like even the emissions of liquid GRAIL are mostly going to projects and their protocol and liquidity. So it makes it for like, hey, there isn't going to be a lot of this token to dump. I think people are highly, highly underestimating that. But this also works if you're like building your own project. Like it doesn't have to just be the GRAIL LP. Like they allow you to set your own parameters around those different fees. Some other cool features just to touch on quickly. So spNFTs, I think these are sweet. There's other projects that use them, but I think they're really the only ones that are going to be using them in the way that they do. So if you stake like ETH USDC as an LP position, you get an spNFT. You can lock that for any period of time. Like I mentioned, they will give higher APRs for anybody who's willing to lock their LPs, which is extremely nice. And once again, it preys on Vampire Capital and says like, hey, we only want like long-term holders and like very sticky liquidity. And it's going to help them so much in a bear market as well. But like you can lock those different tokens based off of some of what I've seen in the chats and from really the team. It sounds like the plan is that you'll also be able to borrow against these. So say you have a WST ETH position, you lock it for 6 months, you're earning yield off of that, and you can stake that NFT as collateral against Sentiment or Tapioca or what are the other lending protocols that are going to be in Arbitrum. So it makes for super sticky liquidity, and you'll be able to borrow against it in the future, which like I think is a pretty massive game changer. This is one of the more exciting things. Like when I heard about their Nitro Pool system, it caters so much to individual projects. Like what they do is they allow you to set parameters for people joining your LP. So say we're going to use Vela again. Say you're Vela and you pair with ETH on their platform. You can decide to pay on top of the GRAIL and xGRAIL that's emitted for your LP. You can decide to give additional maybe Vela or USDC or whatever you really want the reward to be, rewards to that pool. You can make it a Nitro pool. And what that means is you can put requirements on it. So based off that spNFT, you can say, hey, the only people I want to be able to earn these emissions that I'm paying to this pool are people who staked at least $5,000, have it locked for 6 months, and we whitelisted them. It allows you to, as a protocol, to choose, like we have requirements around who our emissions are going to be paid to, which once again, that helps from a protocol level. It helps the entire ecosystem align their long-term users with their emissions. So I think this is awesome. I'm pretty excited about this. I think it gives so much flexibility and allows targeting long-term users that hasn't really been done in the past. But outside of that, like the Arbitrum ecosystem as a whole, like it's growing so quickly and there's so many just sick projects launching. Pretty excited about like them being able to pull a decent amount of these under their wing. Like I do think that they're competing pretty heavily on some of these markets. I know Orbital is going to be a pretty massive competitor. Trader Joe launching tomorrow. But like they're pulling in some of these big names. Like, I mean, Jones has like a lot of their liquidity stake there. They're launching their new JGLP, their JUSDC on there, Buffer Finance, their Umami already on there. They're grabbing a pretty big share of this. So honestly, pretty excited about it. The other piece that I guess is worth highlighting is some of their dashboarding outside of their actual platform. One of the reasons like their vesting is so cool too is you can kind of tell when buying and selling is going to happen. And what I mean by that is because so much xGRAIL is really illiquid and people are forced to vest, you'll look and you'll be able to say like, hey, here's all of the tokens that are vesting over the next 15 days or 6 months. So you know, like when there's going to be high sell pressure, like if you look on this date, somebody is burning 10 of their GRAIL to redeem. Somebody's burning 20 plus GRAIL to redeem. Look at these burns, they're massive. I can't believe these people are taking a 50% hit for this. But like if you get into this period, there can be no more redemptions that happen in these periods because we're already within 15 days out. So there's not going to be really any big unlocks happening over that period from like the 30th to the 8th. But these massive burns, like this person's going to sell because like once again, there isn't much you can do with liquid GRAIL. Like LPing doesn't make a ton of sense. But look at this. This is a massive burn. That's like a huge piece of supply that's going to get burnt on that day. But also it means like, hey, February 9th is probably going to be a pretty good day to buy into the protocol. This helps like really, one, if you're trying to get a position and like do it in the most efficient manner, I would definitely look at some of the dashboards. You just search GRAIL and the Dune dashboard, but pretty cool stuff. And once again, just highlights how stable Camelot is as a whole. When you look at a lot of their metrics across their analytics, it's like their TVL is just steadily rising, liquidity is steadily rising, volume steadily rising. You can tell like when holders are leaving. Like it makes everything so stable in the longer term. Like I think they did a very, very good job. And as adoption grows, the idea is for the near future, burns should be enough that token price should go up. Like that's definitely the goal of like, hey, there's enough volume happening on our platform that there's burns, token price goes up, or there's people buying in. And when token price goes up, what happens? The APRs all go up. And then when the APRs all go up, people flow in from a TVL standpoint. They've, in my opinion, like really nailed like a reflexive cycle. And it's a very good flywheel. So I think long term, they'll probably have to figure out what it looks like from a burn standpoint. If it does start to do $1 billion in volume a day, like I think that might be a little bit of a stretch for the time being until we're in a much bigger bull market. But like they'll probably have to slow down burns. Maybe you have to take a portion of this buyback and burn. Maybe you take 6% of that and you give it to partner protocols and projects, and instead of burning it, or maybe you just give maybe you only burn 1% to 2%, and all like the rest of it goes to dividends. So like as a lot of those volumes pick up and they further solidify themselves, I think they'll have to do some governance changes to like what this actually looks like. But for the time being, I think they nailed it, and very excited to see it grow. But let me know what you think. Leave some comments. Like I said, please subscribe if you enjoyed it. I'm going to try and do maybe one of these a week, and we'll really take it from there. Thanks for listening to the end. All right, have a good one. Peace.